what are green bonds? Green bonds are basically fixed income instruments, which are bonds like a normal bond, which are issued with the objective or by the corporates, which ultimate objective of these bonds are for climate benefit. Like example, a renewable energy power plant, if they raise money, then for that they can issue green bonds. That means the ultimate objective of this is that a solar power plant or a wind power plant is being set up, or a waste management company, because India has such a huge population and we produce so much of waste. A waste management company, they basically, if they issue a bond which is specifically used for this purpose, that is for capital expenditure, setting up a new plant or refinancing a plant which they have used for waste management, then these are green bonds. There are certain green bond principles. These are voluntary guidelines by issue green bonds. That is, these are called GBPs by the International Capital Market Associations. They define this as green bonds. So any money that is raised, which are used, or equivalent money that is used or used for financing, refinancing in part of full for an eligible green project, then it is called a green bond. There are four principles for this. That is use of proceeds. Like I said, what is it being used for? How do you manage the money? The project evaluation, because not every project is going to be a green project, right? So that, and then the reporting mechanism. These are some of the green bond principles that is currently there in the global guidelines. Now, what about the regulatory framework in India? So as such, the regulatory framework is very limited currently. SEBI came up with issue and listing non-convertible debenture regulations, which is 2021 NCS regulations. This is governed by that guideline. Other than that, SEBI disclosure requirements for issuance and listing of green bonds. So any bond that gets listed or has to be listed and to be called as green bond, there are certain disclosures that needs to be given by in the information memorandum. And this is the regulation that that is governed by. SEBI's listing obligation, these are called LODR regulations, which is 2015. That is also applicable on green bonds. Then there is a separate chapter by SEBI Operations Circular for issue and listing of non-convertible debentures. Again, these are the four guidelines under which green bonds are regulated. Hence, it's a completely regulated instrument. Now, covering what are benefits and what are the challenges. Now, all of us understand that the environment is something that we are all taking care. Global warming is something that is a problem. Globally, we've all heard a lot about green bonds. So it definitely, that's a benefit. We are engaging or we're trying our level best to help environment causes through these investing. The use of projects that have positive impact on human life. Now, let's assume that we are using a lot of mechanical instruments. We are using computers, laptops, any company which is recycling this waste also in the most positive manner. When we are saying recycling, it does not mean that you just pick up waste and you just dump it somewhere. No, if it is recycled, if it is used, if it is reused, then these have positive impacts, right? That reduces our overall usage of natural resources because they're limited. Green bonds improve the issue. It overall helps that any company which is raising money through green bonds, or that means they are an environment friendly company. If you, a lot of you guys are Apple users, if you know that a lot of your new Apple iPhones or your computers, they are recycled. Even the packaging is recycled. I understand it's very good quality, but there is a lot of it that is recycled. There is company that is currently being operational who buys these e-products and then they recycle it and sell it back to Apple or any other bigger brands like Samsung maybe. These are companies which have positive impact on the global economies, right? What are the challenges? Now, a lot of times corporates may end up claiming that they are trying to do their level best, or they are technology that they're adapting is green, or they are good for the nature. It can be false. There are very limited checks and balances that is currently there in the system because this is a new emerging concept. That's why the new age fixed income instrument. The second is that there is no regulation in India that SEBI tells the investors that you have to invest in these green bonds, a minimum amount. Like, I'll give you an example. Whenever a bank has certain regulations under which they are supposed to lend to priority sector lending. What is priority sector? Agricultural produce. Just a sample, just an example. So a certain portion of the money has to be parked in priority sector lending. That means they're helping the grass or the ground reality, right? In the same way, banks are also supposed to invest some money in SLR. Like there is a regulation that there's certain amount of money that has to be invested in government securities, which can be 15, 18%. The same way, there is no regulation that is around green bonds. That means that no investor has been mandated that out of 100 rupees corpus, like you and me who invest in mutual funds, if we have invested in any bonds, then there is no mandate as such that investor has to invest 5% of the total AUM in green bonds. There is no mandate as such. If something like that comes up, green bonds will really become something which will be very, which will really pick up in the market. The end use for it to be qualified under green bond, that is renewable and sustainable energy, that is wind, solar, or bioenergy. Clean transportation, you would be seeing a lot of electric vehicles that are right now operational, and people are really pushing. Government has been giving a push even on the real estate space. Government have been pushing that new commercial projects that come up, they need to have EV charging stations. Even residential towers need to have EV charging stations. It's coming from the same guidelines that clean transportation is something that is need of the hour. Sustainable water management, we all have problems at our home for water. Cities are really suffering, so sustainable water management, desalination plants, water treatment plants, these are all under the same. Any climate change adaptations, that is green buildings, energy efficient buildings, these are all under some of the end uses that can be used. Sustainable land development, land use, which is basically you cannot just dump waste in land. So sustainable use of that, because it really spoils the land also if you just dump up. Biodiversity conservation, sustainable water management, we've already covered, and any other category that may be specified from time to time. So these are some of the end uses that we'll be covering. These are some of the end uses that is being currently used.
Having understood what the green bond is all about, we have understood that green bond is about making climate changes, affecting a positive environment in the overall global landscape in environmental senses. We need to also understand what is the market that looks like for green bond. So if we look at the cumulative market on a global landscape, the first table shows us that the total amount of issuances so far in green bond space have been to the extent of US dollars 1.6 trillion, of which in 2021 itself was about half a trillion. So we can look at the pace of issuances, which is in a year, almost one third of the total issuances were raised in 2021 itself. Total about 2,000 issuers have raised green bonds, of which 839 odd issuers were there to hit in 2021. So if we look at number of countries, 80 countries have participated in green bond issuances, of which 58 were in 2021 itself. And it has been issued in 47 currencies so far, of which 33 were issued in 2021. If we look at green bond concept in India, the market is still evolving, as we discussed. As we go along, we will see more of mandates coming in to the investors to invest in green bonds, and therefore the market size will expand. But as we speak, in 2021, there was a cumulative market size of 18.9 billion in Indian market for a total amount of green bond issuances, of which about 7 billion was in 2021. If we talk about the largest issuer which has been there in the green bond space, it was Renew Power. On an overall basis, they have been the largest issuer, having issued $2.9 billion worth of green bonds. While in 2021, Adani Green Energy was the largest issuer, having issued bonds worth $2.1 billion. So what has been the emphasis and what has been the origination for green bonds? Lately, in our finance budget, the Honorable Finance Minister on February 1, 2022 made an announcement that there is an intent for Government of India to be issuing sovereign green bonds which will be at domestic level, Government of India issuing green bonds. So this kind of initiative has been thought of, and it is in the process, which we could see very shortly, government issuing green bonds. If we look at history, it was around 2015 when global economies realized that they should be contributing towards low carbon future and positive environmental impact. And that's how around 2015 February, Yes Bank made a debut with 10-year issuances in euro currency terms for an issue size of 161 million, which was followed up by issuers like Exim Bank, CLP Windfarms, IDBI Bank, and IREDA. So these issuances were essentially one of the first issuances in Indian space for issuing dollar worth or Indian rupee worth or euro currency worth of green bonds. So if we look at the aggregate number of amount of issuances been made, the prominent issuers that come to our mind is Adani Green Energy, Indian Railway Finance Corporation, which is a Government of India undertaking, Azure Power Energy, which is in renewable space, Power Finance Corporation, again a financial institution promoted by Government of India, Renew Power, which is again into green energy sector, Vector Green Energy, and lately Ghaziabad Municipal Corporation. They have issued 150 crore worth of green bonds on Indian landscape in terms of INR denominated green bonds. Coming to bank bonds, basically we all know that there is a talk in the town that there are bank bonds available. How do they differentiate in terms of characteristics? What returns could they provide? So basically, there are two types of bank bonds. First of all, we should understand why banks issue bonds, because as we all know, banks are funded through deposits. So primarily the source of funding for banks is their deposits, which are time and demand liabilities. It could be saving banks account, it could be current bank accounts or fixed deposits. So banks act as financing vehicles. On one side, they raise funds through deposits and they then get into on lending to various projects. Basically, there are three classes of bank bonds. One is a senior bond. This bond is raised by a bank to finance infrastructure projects. Typically, banks raise deposits which are short term in nature, while they also invest in infrastructure sectors which are of long term in nature, and therefore their funding goes as high as more than 7 to 10 years. It runs into at times 20 years as well. So they need to shore up their long term capital base, the long term resource base, to be able to fund such infrastructure projects. So therefore they raise unsecured bank bonds, basically to finance infrastructure projects. These bonds are at par in terms of claims of investors. They are at par with other depositors of the bank, and therefore they are almost as secure as like a fixed deposit. The minimum maturity for these bonds has to be 7 years as per the RBI provisions. The next category is a Tier 2 bond, where again it is an unsecured instrument. For that matter, all the deposits of the banks are also unsecured in nature. So the claims of Tier 2 bonds are those subordinated to the claims of senior bondholders, the previous category. Here, the minimum tenor could be 5 years, or if let's say a bank issues a bond with tenor of 10 years, they have the option to keep a call option, which is a discretion at the bank, with the bank side, to redeem the instrument prior to its maturity. So often in this space, we find banks issuing 10-year bonds. That is, the bonds will retire at the end of 10th year, while there is a call option at the end of 5th year. So bank may so decide to extinguish the instrument after 5th year by making a premature redemption. There are some loss absorption features attached to bank Tier 2 bonds and AT1 bonds, where at certain stages, if banks are supposed or it is deemed by the RBI that they are heading towards a point of non-viability, these amount of these bonds could be written off. Though these situations are remote in nature, but still it is an embedded feature which comes in bank bonds. Then the third category is 81 bonds, which are essentially perpetual in nature. So if I invest in a perpetual bond of a bank, basically I am not entitled to encash that bond or get a redemption of that bond during the life cycle of the instrument. All that I have a claim is a particular rate of interest at a particular periodicity. So generally these bonds are issued with an annual interest payment. So all I receive is annual inflow of interest on these bonds. While there is an exit option because these bonds are traded in the secondary markets. So one can easily sell these bonds. They are more like equity. Why? Because equity doesn't have a retirement date. And the moment you want to liquidate your investment, you can sell your equity shares. Likewise, you can sell your 81 bonds to get premature kind of redemption exit out of your investment. So having said that these are perpetual in nature, there is an embedded call option, which generally banks retain after 5 years. So essentially, perpetual bonds are seen as an instrument which is of long term in nature, but there is an exit mechanism built through listing and option with the bank to retire the instrument after 5 years.
Are these bank bonds listed or are they unlisted?
Yeah. So as per the mandate, the banks are essentially required to issue bonds which are listed in nature. So far as we discussed about the volumes of bonds outstanding on domestic landscape, all these bonds are listed and therefore they are liquid. You can sell the bonds in the secondary market. So this is something we discussed about seniority of bank bonds. The senior bonds are the safest bet and therefore they carry the lowest rate of interest among categories of bank bonds. As you move forward towards subordinated tier 2, they yield higher interest and therefore the risk element is a bit higher. 81 bonds will have further incremental risk and therefore they will tend to cover higher rate of interest. While equity, there are ups and downs, but in terms of riskiness, that is the highest risky asset. We need to now understand that we have understood various classes of bank bonds. What is that we can expect as a return out of these bank bonds? So there are two classes of banks. One we all know is the PSU sector, where these are nationalized banks owned by majority of which is owned by government of India. Then there are private sector banks. So, for example, we have, for demonstration purposes, we have taken few PSU bonds and few private sector banks. Bank of Baroda, for example, if you note at the maturity side, it says call option date. So it means there is no fixed maturity attached. It is an option with the bank to repay at a particular point of time. So which is, say, December 2024, the bank will have an option to call back that instrument and repay the money back to investors. So then it gets termed as a bank 81 perpetual bonds. It is rated AA plus, which is next to the highest rating in our financial markets. It carries a coupon of 8.99% and it is being traded at a yield of 7.65%. To sum it up, basically, we can expect a yield of 7.65% coming in from a credit like Bank of Baroda, which has been a nationalized bank, which has a history of about 100 years now, and an instrument which is expected to retire by December 2024, which is a very short-term investment. Or otherwise, you can sell it in the secondary market at any point of time, as we discussed. This yields you 7.65% against the return which we fetch if we had invested in fixed deposits of Bank of Baroda. I am sure we will not attain a yield of more than 5 odd percent with if we park our fund in deposits of Bank of Baroda. So these bonds provide a clear markup and incremental earning over bank fixed deposits, which has a lot of acceptability amongst all of us. We keep our funds liquid through by parking them in bank deposits.
What is the minimum amount that we can invest in bank bonds?
Essentially, we have seen the face value of a particular bond as 10 lakh rupees when it comes to bank bonds. So minimum investment we can say is about 10 lakh rupees. Depending upon how the market forces work, if the interest rates go up or down, the value of that 10 lakh rupees will accordingly move up or down. Therefore, you would see the prices being indicated as 10 lakh 76,000 in case of Bank of Baroda. So investment size is generally the face value of rupees 10 lakhs.